I, like everyone else, has been somewhat interested in the cheerleading that has followed the US and other markets reaching new all-time highs. In fact, a simple search of Google shows me that if I stick in the phrase stock market all-time high, I get some 334 million returns. So it must be popular because Google tells me so. What this tells me is that there's no shortage of gibbons offering any manner of prognostications as to why this might be so, as to why markets might actually be hitting all-time highs. But there are two problems with this, and there's two problems with the commentary that's being offered. The first is that commentators are continually late to the party. The reason as to why I say that will become apparent in a moment. The second issue is that they also cannot interpret data correctly. It is almost impossible to present a commentator with a piece of data and get a sensible interpretation of that data, and from that you can't define any sensible explanation of the data either. The reason I say this will also become apparent in a minute, because much of the commentary is missing a very, very important element. The reason I say that commentators are continually late to the party is simple. This is a chart of the Dow Jones, and it covers the period 2006 to the present day. Since 2009, the Dow Jones has been going up. It has shown an archetypal uptrend. You have higher highs and higher lows. This market has been going up for 4 years, so the fact that it has hit a new high is really somewhat irrelevant because of the extraordinary gains it's made in the previous 4 years. Interestingly, the gains that it's made in the previous 4 years have been completely ignored. And they've been completely ignored largely, I think, because commentators don't actually have their eye on the ball. The ball in this issue is price, and that's all. But commentators are like 2-year-olds. They're very easily distracted. So they're distracted about gibbering on about the economy. They're distracted about gibbering on about the US election. And so they've missed this picture completely. So the fact that the market has hit an all-time high is somewhat staggering to them, because one day they would have woken up, looked at the market and gone, good God, it's at an all-time high. When did that happen? That must have just happened yesterday. So their approach to the world is that since 2009, the Dow's been at 6,500 points, and yesterday it went straight to 14,300. They've simply missed what is happening. And the issue is that the data pointing to this is everywhere to be found. This is a very simple chart. It simply shows the number of stocks on the S&P 500 that are above their 200 period moving average. And you can see the period 2008-2009, which was reflective of the low point following the fallout from the GFC. You have this almost complete collapse in the index and all stocks within the index. The number of stocks above their 200 period moving average then begins to accelerate, and it takes off through the period of 2009, and it stays high and does not approach those levels again. The same is true is if we look at the NYSE cumulative new highs, new lows. Again, you can see the bull market from 2003-2007. You can see that at that point the bulls are in the ascendancy. 2007 GFC unfolds. The bears are now in charge. Come mid-2009, the tenor of the market changes. The market begins to swing up. You have more stocks making new highs compared to those making new lows. So once again, the bulls are back in charge, and they're back in charge firmly, and they have been in the US for some 4 years. We can see this again in another metric. This is simply the cumulative advanced decline line. 2008, 2009 is one of collapse. But again, this metric swings in 2009. We get a positive spin on what's actually happening. The issue then becomes, and this is why I mentioned that commentators can't interpret data correctly. Why I say this will become obvious in a few moments. This is our market. This is the All Ordinaries. As you can see, the All Ordinaries has effectively gone nowhere for 4 years. We did have a bounce post the GFC, but since then the market has traded in a range of anywhere between 750 to almost 1100 points, with some sign of life coming back into the market in the last quarter of last year. And I want to briefly look at some reasons as to why we might have this poor performance during this period. But I freely admit these are post hoc rationalizations. I have no idea if they're true. They're just my interpretation of the problem. This is a league table of a few indices I threw together. This is the change from their GFC low. And you can see the standout winner is the NASDAQ 100, the tech-heavy NASDAQ. Many commentators will say that this is simply the result of Apple being in the index. Once again, that's an inability to interpret the data correctly, because there is an ETF which is an equal-weighted ETF of the NASDAQ 100, and what it does is it pars back Apple's influence on the index, and you still get a very similar gain. It's not as extreme, but it is in the ballpark. We can see that our All Ordinaries, post the GFC from 2009, has had quite a modest performance. It's really been quite poor when we compare it to other indices. You can see below us is the Euro Stoxx 50. Europe has suffered from the impact of Greece, Italy, Spain, Portugal, Ireland. So this conglomerate index has struggled. But if you look at the DAX and the FTSE 100, they've done considerably better than we have. And down the bottom of the list is the Shanghai Composite, and I'll talk about the Shanghai Comp in a moment. But I've also highlighted the Aussie dollar. There is a reason I've highlighted the Aussie dollar. It's had a remarkable series of runs post 2009, where we're now sitting beyond parity with the US, and we've sat beyond parity for quite a while. One of the reasons that I think that we have performed so poorly in the past 4 years or so has simply been the continual movement in the Aussie dollar. The fact that the Australian dollar has not been stable in terms of any form of currency transaction. It has been trending up. This is a problem for overseas investors for a simple reason, and I'll use an analogy to explain why that is for people who are unfamiliar with currency-based transactions. Over the past few years, there have been a variety of spruikers here in Australia who have pushed the line of buying distressed US real estate. The US real estate market has been savagely reamed over the past few years. And these spruikers go along the lines of, you can buy a somewhat rundown US property for $10,000. There is a problem with this as an investment strategy. Not only is it a crap idea, but it also suffers from a fundamental flaw. And this flaw arises from an inability to understand how changes in exchange rates affect international investments. If in 2009 I went and bought a US-based property when the dollar was at 65 cents, I have now done investment. And this has occurred simply because the Australian dollar has gone up. As the Australian dollar has gone up, the repatriation value, that is the value of that investment should I sell it and return the funds to Australia, has dropped precipitously. In fact, if I had bought at the 2009 lows, it has dropped 62%, which is the gain in value of the Australian dollar post that point. This situation works in reverse for foreign investors. If I'm a foreign investor and I'm cashed up in US dollars, I don't want to be buying into an index or an environment where my counterparty currency is going up in value, because as it goes up in value, the value of my investment in that country goes down. So unless foreign investments are going up dramatically, any repatriation of the funds causes me to either be stagnant or show a loss. So our rampant currency is a problem. But now that the currency is stable, it's a little bit easier for people to manage. With it trending up, it is too hard to manage from a corporate risk management perspective. It's very, very difficult to do. Many people offer the line of, well, why don't they simply hedge? Hedging is expensive. Hedging is not free. There is a myth in the market that people have that when you hedge, you do it for free. That's not true. Think about it in the context of insuring your house. When you insure your house, you are effectively hedging it against external risk. In doing so, you pay a premium, a cost. Just like insurance, a hedge has to be continually managed, so they become expensive. They're also quite complex to do, and you can get them very, very, very wrong. So the dollar is an issue. The other issue can be highlighted here. This is just our league table in a different format. I've highlighted the Shanghai Composite. My perception of the Australian economy is simply this. We are a dirty big hole in the ground that ships stuff to other people. Other people then turn it into something useful and send it back to us. These things they send back are much more expensive too. This is not a new problem. For those who want to do a bit of Google foo, simply Google the expression pig iron bob for a little bit of a history lesson. The issue with the Shanghai Comp is this. We are dependent for the engine of our economy on China. As China begins to slow, as it begins to experience structural issues, we are affected by that. We're caught in the wake of those problems. That's simply the way the world works. And if I compare our two indices, if I compare the All Ords with the Shanghai Comp, I can make a judgment that they sort of look the same. But here's where the interpretation of data becomes a problem. Looking the same and being the same are not the same thing. So we need to be careful. We can see that both have been flat, both are very ordinary. But interestingly, in the last quarter of last year, we stopped being ordinary, whereas the Shanghai Comp has largely continued to be ordinary. So the issue here is to understand that when you look at an index, you're looking at a future pricing mechanism. What the Shanghai Comp tells me is that the market's perception of China is divorced from the populism of China, from the cheerleading we hear about China. The index tells me the true story. You need to be very much aware of that. But as I said, because something looks the same doesn't mean it is the same. These are a series of correlation coefficients comparing the All Ords to the Shanghai Comp, the S&P 500 and the Nasdaq 100. All a correlation tells me, and this is a very important point, is if A goes up, does B go up? And if B does go up, by how much does B go up? You can see we have a loose correlation with the Shanghai Comp. So what you see here, when you look at this in a very simple way, is not actually reflected here when we begin to crunch the numbers. And that's very important. We can see that we still have a very strong correlation with US markets. But again, this is not telling me a lot. What I really need to do is to look at the correlation in returns between the two markets. This is what I have done here. I've taken the All Ords and the Shanghai Comp back to 2008. I'm looking for a correlation in returns. I want to see how the returns map one another. Over the longer term, you can see that we tend to mirror post 2008 the Shanghai Comp. Now, it may be coincidental, but when you look at correlations, either simple correlations or correlations of return, you need to be very careful, because setting the time frame of the correlation has an impact upon what you see. This is a very complex problem and is difficult to see and difficult to interpret. But what I might offer is that whilst we can see that for us, the period 2009 to present has been a time of ordinary returns, as it has for the Shanghai Comp. And remember, correlation is not causation, so we need to be aware of that. But what I would offer is that that period is irrelevant. That this period of poor returns that we see here is completely irrelevant. And it should be totally irrelevant to an equities trader. And the reason this period is irrelevant through here, this one I've highlighted in blue, is completely irrelevant to you, is simply this. This is the ASX 100 advanced decline line. And through it I've just plotted a longer term moving average. You can see the bull run from 2003 to 2004 through to 2007. There's a small blip post the GFC, which was our recovery bounce, which does catch you. That just happens, deal with it. No trading method is perfect. But for the bulk of that period, there is no conceivable reason as to why you should be buying Australian equities. And if you were, your level of understanding of the market and your level of perception regarding the market is on par with probably an Australian superannuation fund manager, which in my opinion means you're probably not fit to run a Mr. Whippy van. So trading is so far beyond you as you might as well want to give up on it. When advanced decline lines fall, they're telling you something. And I hasten to add, there is nothing unique about any of the tools that I've presented here. They are all freely and publicly available. You just need to use them to interpret them. So this tells me a different story. This tells me that my period where I was worried about the returns is simply an irrelevancy to me, because I should not have been in the market anyway. And anyone with any common sense would not have been in the market anyway. But we can see this bounce that starts in the second half of last year and really gathers strength in the last quarter of last year. This tells us a very interesting story. This leads us to something new in terms of returns. I mentioned a moment ago that when we looked at the correlation of returns, when we looked at how markets performed and whether they were interrelated, timing was everything. What I've done here is I've simply taken the time frame back 6 months. And so the All Ordinaries has gone from being an extremely ordinary performer to being a very, very good performer. And in fact, in the time period that is shown here, comparing it with the Shanghai Composite and the S&P 500, it is the best performing index. And that's what we're seeing. That is important to us because the period from September, October, November last year, as we see here, is the period that is important to us. That's the one when we have switched on. This raises the question as to what is the answer to the problem of markets moving? What is the mechanism that we use to approach the fact that for the past 4 years we haven't moved, but the US has? We're now moving, and we're moving quicker than the US. Well, the answer lies in one of my childhood toys. Those of you who are from a certain generation will recognize this. This is a Gumby. The good thing about a Gumby is they're indestructible. They're indestructible because they're flexible. They move in any way that you apply pressure to them. This to me is a perfect analogy for a trader, in that if you do not have flexibility, if you do not have a fluidity of mind and an ability to step back and think about what is happening, not listen to what other people are telling you is happening, but actually think, and that is the difficult part for most people, and I do apologize if that is insulting, but thinking is not the default state for the majority of people. Once you get into the habit of thinking, once you get into the habit of stepping back and looking dispassionately at what is happening, you will see that the trading world, despite what you might be hearing, is full of any number of opportunities for you to profit from.